administrative standpoint. We're going to go over a couple different factors you need to consider there. Then we're going to go over making sure you operate it properly. A lot of people set it up right and don't operate it properly. Or a lot of people set it up wrong, but they got the operations down. They're just operating the wrong thing. And so you've got to nail both pieces. You got to set it up right, have the proper structure, and then operate it properly. All right, well, let's go into making sure you set it up properly. And to do that, we always start with the trifecta. This is something my partner, Mark J. Kohler, and I have developed over the years with clients and working with them to determine how do we make sure this is optimized from a tax and legal standpoint, because I want to make sure I'm paying as little tax as possible and having as much asset protection as I can get. And we generally split your life up into two different columns here. We have business here and making income, sometimes called ops. And then we have building assets or investments. Okay. When I'm starting a small business, I'm over on this left side over here. And generally, this could be an LLC or S corporation. I'm going to talk about that and what to set up. I go into detail on these in other videos and the tax strategies and benefits. I'm going to hit it from an overall standpoint here so you know where to go. But you've got assets. You maybe got your home over here. You've got your brokerage account. You've got your rental property. Maybe that has an LLC. Okay. And then we've got you down here with your trust. This is where you're filing your 1040 tax return. Okay. Everything's flowing down to me. The reason we break this up and why I want to show this from the beginning is I want to be very clear. Over here on the left side is where we're setting up your small business if it's an operating business. Okay. If you're selling goods or services, we want you to have an LLC or an S corporation. And if you're making more than 50K net, 50K plus a year, I want to do what's called an S corporation or an LLC tax as an S corporation because you save on self-employment tax. Now, I've got other videos on that. We'll drop them in here about how the S corporation saves you on taxes. Even Joe Biden's done it. His wife, Jill Biden, used it. I use an S corporation. You know, it's a very common tax strategy used to minimize taxes on a small business. But I don't do it if this is a side hustle making 10 grand. The cost to have the S corporation and do the S corporation tax return and payroll isn't worth it. Just be a sole prop or just an LLC with the lower tax filing requirements. But if I'm making 50K or more, the tax savings definitely will pay off. So, so just know that we're going to typically do an LLC or an S corporation for an operating business. All right. Now, on the other hand, if you're like, well, Matt, my business is a rental property. I'm doing buy and hold rentals. They give me short-term rentals, midterm, doesn't matter, but I'm doing rental properties. Well, that's a business and an asset. So we categorize that differently. So I will put that over here on the right side of the column here in an LLC that I own. This is your trust if you have one for estate planning. And by the way, you should have one, not topic for another day. But this is my rental property here. Okay. I got my tenant who's paying rental income to my LLC. And then I send money from the LLC down to me. Now I'm going to get into the operations of this and where the money needs to flow to do it properly. But that's a good little outline here of tenant is paying your LLC, which owns the rental, and then you own the LLC down here. Now there's a couple reasons we do that. The primary one is being asset protection, right? If something happens on the rental property, the tenant slips and falls, they're forced to sue the LLC. They can't come after you. They can't get over here to my other business. They can't get to my brokerage account or my home, right? They're stuck here in the LLC. So I get that asset protection, the limited liability, that's the L&L in LLC. So I'm using the LLC for rental properties for asset protection. Now I've got asset protection over here in my LLC and my S Corp for my business. Again, whether it's a main hustle, side hustle, something goes wrong in the business, they're forced to sue the LLC or corporation. I got a customer gone bad, a deal that goes bad. I got a creditor issue or whatever at the business level. They're forced to sue the entity, the LLC or the S corporation. They can't come over to my rental properties over here. They're stuck. They can't come down to my trust or to me personally. They can't get it from my brokerage account or my home. Okay. The liability is contained in the entity itself. That is one of the primary reasons, whether we're talking about an operating business where you're selling goods or services, or whether we're talking about a rental property business or entity, in either in either side of the equation here, left side or right side, I have an entity for asset protection. Now, on that left side again, I'm getting tax planning because the income that I get from selling goods or services is subject to self-employment tax. So I might use an S corporation. Again, a video for another day. But I want to make sure everybody starts off with making sure they get the right entity to set up. And as a rule of thumb, if you don't know, do an LLC. Okay, right. If you skied Jackson Hole, by the way, you get to the top of Jackson Hole on the tram, it's all expert skiing down the hill. And they say, if you don't know, don't go. Well, in the entity world, if you don't know, go LLC. Okay, because I'm at least getting asset protection in an LLC, and I have the flexibility to adding an S corporation tax election to it later on down the road. So some people start off and they're like, Matt, this small business I'm starting, it's a side hustle. I might make 10 grand net this year. Should I do an S corporation? I'm like, no, it's not worth it yet because you don't have 50,000 of net income. The tax savings don't arrive in an S corporation until you hit that 50K level. But we can just do an LLC, and as your income increases and you get to that 50,000 level, we can add the S election to it, and the LLC turns into an S corp for tax purposes. So it's very easy. You can kind of grow into the structure. So the first thing you want to make sure you identify is that I have the right entity for the right type of business. Now, some people like to ask, well, Matt, what about a C corporation? When do I use a C corporation? So let me kind of break these down into 3 different categories. LLCs, I'm going to use for rentals. I'm going to use for partnerships. I could add a tax S election to it for a small biz selling goods and services. Okay, that's when I'm using LLCs is over here. And all 50 states, by the way, if you're doing business in Florida, we're going to do a Florida LLC. If you're doing business in Arizona, we're going to do an Arizona LLC, okay? Don't make the mistake that Elon Musk did in running a business out of Texas, but really having it set up in Delaware, okay, right? He's just, by the way, the shareholders just approved that change, and they're moving from Delaware, which is a state a lot of people thought that's where you should set up your entity, in Delaware, even though you have no business being there, you have no employees there, you have no office there, the owners aren't there. Let's just set it up in Delaware. That's kind of going out the window. Set up the entity where you're doing business. Okay. All right. Now, when do I use an S corporation though? Okay. S corporation, small business. I want to use an S corporation for a small business. Never use an S corp for rentals. Never use an S corporation for rentals. It's very hard to get a property out of the S corporation unless you sell it. There's also passive losses, limitation rules for S corporations, where a lot of people with rental properties can cash flow the rental, but they get a tax loss. Well, there's passive loss limitations in an S corp that are going to make that loss unable to use, and you can even lose the S corporation tax status. So it's a mess. Avoid you putting rentals into an S corporation. So the S corporation is really used for small businesses, okay? Selling goods or services. I have an S corporation that owns my share of the law firm. I sell my books, or my speaking fees come out of my S corporation. I get all their consulting income into there. That's all goods and services, right? Consulting, advice, like that's all goods and services. All right, now what about a C corporation, Matt? All the big publicly traded companies are C corporations. The time you want to do a C corporation is if you want to go public, you're raising investor capital for an operating business, and like, let's say it's like from venture capital or private equity. Because of their investors who's putting money into their funds, a venture capital fund or a private equity fund, they want you to be a C corp. It's better for their taxes and easier for them. Actually, as an investor in your business, it might not be better for you as the primary shareholder or the major shareholder of a C corp. But if you're a startup trying to go public, or you're getting venture capital or private equity money, even if you are an LLC, you might have to convert to becoming a C corp. Not always, but that's kind of what an institutional investor is going to expect when they think you're going to turn from a small business to a really big business. Sometimes we'll use C Corp in special tax situations. Like if there's a blocker situation, or maybe there's some unique tax planning happening. This is like for 2% of clients. This is not the majority. So let me just give an overview here. I'll bet for every 100 entities we set up, I'll bet 90 of them are LLCs, 9 of them are S Corps, and 1's a C Corp. That'll just give you an idea. LLCs are way more popular, way more flexible, great for partnerships. They're great for rentals. You can do an operating business out of it too, because you can add the S selection. S Corps are still very popular because if you know you're a small business selling goods and services, you're going that structure out of the gate. Just be an S corporation. But then the C Corp is just, there's not a lot of businesses that are trying to become a public company, right? You're definitely never put a rental, by the way, in a C Corp. Oh, that's the worst thing you could ever do. Okay, rental income is exempt from self-employment tax, so I don't need to put it in an S Corp. When I get rental income, I pay it at my regular tax rate, but when I sell the property, I get capital gains rate. Well, if you do that in a C corporation, you're going to pay corporate tax, which is more than capital gains rate, and you're going to pay a dividend tax. So you're paying double tax over here. So be very cautious about a C corporation because it pays a corporate level tax, and then at the company level, and then it distributes profit down to the individual who again pays tax, the owner of the C Corp. So it's that kind of double taxation. LLCs and S Corps, there's no entity level tax. There's no LLC level tax. There's no S Corp tax on the federal level. You only pay tax at the individual level. It passes through to the owner of that entity. So it's called a pass-through entity. Okay, so those are going to be your 3 main choices. Make sure you're getting the optimal entity for your situation. The best way to do that is talk to a lawyer that knows what they're doing. Our law firm, KQS Lawyers, is helping clients every day. We're setting up 500 plus entities a month for clients across the country, making sure they have the optimal structure. Okay, we go over the trifecta and how to make sure it's set up properly. So you can get over to KQS Lawyers, we can help you, or just use a law firm that does business and tax planning for small business owners and investors. Like, we're not the only ones out there. This is not necessarily a promotion for that. It's just like, make sure you get competent advice. The problem we see is too many people go out on their own, or they use some online website or something that has no advice. They don't know what's right for your situation. And so they get a structure that is not optimized for their situation. All right. Okay. Now we've got the entity set up. Okay. We set up the right entity for your business. Let's just say it's an LLC. Okay. Now let's dive into, how do I use an LLC properly? I set an LLC up for my business, but what do I need to make sure I have done for my LLC? The first thing I always tell clients to do once your LLC is set up, and assuming you set it up properly, the first thing I want you to do, open up a bank account. You need a bank checking account in the name of the LLC. Why is that important? 2 reasons, 2 really, really big reasons why the bank account for the LLC is critical. First, asset protection. When you have an LLC and you have a lawsuit against you, let's say that happens, heaven forbid. And by the way, if you're in business long enough, it's going to happen. Okay. You have a lawsuit against the LLC. You don't want any of your other assets at risk, right? Your personal assets, your other businesses or entities, your retirement account. You don't want those things at risk. So one of the reasons we did the LLC in the first place is to make sure we got asset protection. Well, do you know what a court's going to do when they look at your LLC to make sure you get asset protection? They're going to say, did you treat the LLC like a separate entity? If you just treated the LLC like a personal run business, like you're a sole proprietor, they're not going to recognize the LLC for asset protection. For example, let's say you had an LLC. Let's just say it's a rental property. Keep it simple. And let's say that the tenant slips and falls. Happens all the time. There's a lawsuit. They sue you personally. You're like, you can't sue me. You have to sue the LLC. And then tenant's like, but wait, when I paid rent, I paid it to your personal bank account. I wasn't paying the LLC. You might have put the LLC on some documents and paperwork, and I'm going to come back to that. We still need to do that. But if you weren't having me pay your LLC and you're not using the LLC's bank account to cover expenses on the property, why is the court going to recognize the LLC was the party here involved? So there's this kind of what's called piercing, the corporate veil, where a plaintiff can go right through your LLC and say, hey, you didn't treat the LLC like a real entity. It didn't even have its own bank account to receive income and pay its expenses. So first reason we want a bank account is to make sure we get the asset protection of the entity. That bank account's going to receive income for the business, and it's going to pay the expenses out of the business. Okay. That is the number one thing I can do to ensure I get asset protection. By the way, we work with Titan Bank across the country too, a great bank online, excellent resources and tools online. For any of you small business owners, you can use Titan Bank. But whatever bank you're using, just make sure it's in a bank account in the LLC's name, not your personal name. Okay. If I'm doing stuff in my personal name and I have an LLC, I'm getting zero asset protection benefits of the LLC. Okay. The second reason we want to use a bank account, taxes and bookkeeping. Now, many of you small business owners are terrible at doing bookkeeping. You don't have an accounting and finance department. Maybe some of you have a bookkeeper you pay or an accounting firm you pay that helps keep your books. But the easiest way to make sure you're tracking your income and expenses properly, and particularly your expenses, kind of because we want to make sure you're writing everything off. But the best way to remember that is to use a bank checking account. Have a debit card associated with it or a checking account obviously associated with it. So you're tracking all the expenses. So at the end of the year, if you're one of those lazy people on doing bookkeeping, you don't have the accounting and finance department, you can at least look through that business bank account and easily make sense of, I only use this card for business expenses. So that Amazon charge, that must have been office supplies. That wasn't a personal thing because I would have used my personal card for that, right? Okay. So if you get in the habit of using your business card for business expenses, that meal that you went out to in January of 2023, when you're doing your taxes in April of 2024, or heaven forbid you even extend into September, are you going to really remember that meal you took a year and a half ago when you're finally doing your taxes? And that could be an expense? No. Okay. Are you going to remember whether that was personal or business? No. But if you use the business bank card for those business purpose meetings, it's much more easier to do your books and keep things straight. And the clients of ours that use business bank accounts and are very on top of their bookkeeping just have more expenses, not because they're spending more, but because they're capturing more. Okay. So many business expenses are lost from our clients I've seen over the years that fail to do good bookkeeping or have a separate bank account so it's clear what was business expenses. All right. The other thing we need to make sure when operating the LLC that we do properly, you've got to put it in contracts, put it on documents, put it on deeds. When you're doing business and you have an entity, LLC or corporation, that should be on the contract. If you enter into an agreement with someone for services, or you're hiring a vendor, an employee, a contractor, that should be the XYZ, consulting LLC or XYZ business services, whatever it is, LLC should be the party on the contract. Do not put your personal name on it. Do not enter into contracts in your personal name. When you do that, you're volunteering personal liability when you have an LLC and you don't have to do that. So we want to minimize your risks in the business, right? The whole reason people are setting up businesses and entities is to build wealth, right? That's one of the primary reasons to have an entity in a small business or investment assets is we're trying to build wealth. Well, we also want to minimize our risks, okay? Sometimes wealth building, when you have a business, it could cause risks, right? There's certain risk we're taking to do that. Well, let's minimize that. Let's not put everything out there, all our eggs in one basket. Let's use the LLC. So make sure it is in the contracts. For you rental property investors, make sure it is actually on the deed. So if I'm using an LLC to own my rental properties, I need to make sure that property is deeded into the LLC. A lot of clients will close in their personal name for mortgage purposes or getting the loan or debt. And that's fine, but after you've closed, deed it to the LLC. And don't worry about the due on sale clause. Banks don't enforce that stuff as long as the mortgage is getting paid. We've done 10,000 plus deeds for clients from their personal name into LLCs that they own. And I think 2 or 3 times I've seen the due on sale clause called, and that's because they weren't paying the mortgage in the first place. So make sure you're actually using the LLC, okay? Put your contracts and deeds in the name of the LLC so that if a dispute or an issue arises, heaven forbid, you can be like, that was the LLC. Go sue the LLC. Don't come sue me and come after all my other assets or entities or home or bank account or any of that stuff. You can't touch it. You can only get in what's in the LLC. Okay, next thing. I want to talk about insurance just for a minute. Sometimes you're going to want insurance. Now, it depends on your business and what you're doing. Let's talk about the rental property. Obviously, just get a landlord-tenant policy, but the LLC needs to be on that. Okay, whether you're an insured and the LLC is an additional insured, or it's in the LLC's name and you're personally an additional insured. Generally, you want just you to be insured and the LLC. There's no additional cost to that with insurance agents, but make sure you have a landlord-tenant policy for any of you rental property investors. For you business owners, you're providing goods or services, you're just going to want a general liability policy. Okay. Now, you might have a location like a storefront or an office where customers or employees or other people come to, that could cover that. If you provide a professional service, whether it's medical or legal, like us, I have malpractice insurance. Some of you might do an errors and omissions insurance for services you provide. There's all different types of insurance depending on your entity, but consider that. Don't think just because you have an entity that you have asset protection that you skip insurance. Insurance is, again, still a good way to mitigate risks. So I want to make sure that I have the basic insurance for my specific business, but it's different for everyone. Some of you, malpractice insurance doesn't matter. E&O insurance doesn't matter. You're like, I sell a good, I'm selling an actual product. Those aren't things I would typically have. Obviously, landlord-tenant depends on your situation. And general liability and property only depends if you have a storefront or somewhere where customers or employees or contractors or other vendors may go on. All right, so I'm operating the entity properly. I've got my bank account dialed in. I'm using it properly. I'm receiving my income in it. I'm paying my expenses out of it. I'm using it for contracts. I've got it in my business card. And when I'm marketing, it's very clear. I'm using the LLC, my standard form agreement for services with customers, whether that's a lease or whether that's a customer agreement or service agreement or terms and conditions, whatever it might be in your business, that's in the LLC's name. And you have one, by the way. If you're thinking, oh, I don't have one of those, you should have one. Don't just be invoicing people, have an actual agreement for services, because that's to protect you. That's to be clear about what you're going to deliver. When is the money refundable or not? What is they supposed to do on the customer's behalf? Be clear about that. And again, make sure it's in the entity's name. Don't forget insurance. And then the last one here that I'll just add is making sure that the tax reporting is being done properly. When you're operating with an entity, don't be giving your social security number to people that pay you. Sometimes you're going to be doing services or have a customer, let's say you're in the business B2B, business to business scenario, and they're like, hey, I need your W-9 because we got to 1099 you. You're providing services for us. Let's say you're an electrician, okay? And the general contractor is like, hey, I'm going to pay you. I need your W-9 is what it's called. Well, what's a W-9? The W-9 is a IRS form that you give to someone that says, hey, XYZ Services LLC has a tax ID number, and it shows the tax ID number on your W-9, and it tells them, send 1099s when you pay the business to the LLC, to this EIN number, all right? And so you got to be used to giving the W-9 and make sure you're using that. We see clients all the time. They end up getting all these 1099s to their social security number because they weren't using the entity properly. And then it's a bunch of accounting gymnastics to try to get that income over in the entity. And sometimes you miss out on stuff and it causes more problems and it's more audit risk because your tax return's a mess. Okay. So make sure you're using a W-9 and that anyone who's paying you that's going to send you a 1099 knows the EIN for your LLC or corporation, whatever it may be. All right. Okay. So now we have the optimal structure. Now we're operating it properly. I want to hit one final thing here about what should I consider as I'm growing my business. Let's say I'm having success in my business. And let's just go back to the top here to the trifecta. Okay. Let's say you're over here making $500K a year. Okay. You're crushing it. You're doing great. This could be 300, 200, whatever. Just roll with me here. And in that scenario, you're selling goods or services. Okay. That's your business. Maybe you've got some employees here. You've got you're taking and that, by the way, this is 500K net income that you're taking home. You've got the S corporation structure because that's going to save you on taxes. But you might want to start building assets. See, wealth building for business owners is I'm trying to drive more income over here, right? I want to have the business create more and more income for me. I want to grow the business itself, but eventually I want to start adding assets. I want to start investing in my brokerage account. I want to maybe start paying down debt that I have. I want to start acquiring rental properties. I want to start doing retirement accounts. If I don't have them, maybe I'm doing a 401k or IRAs or HSAs. I'm putting money in every year into these special preferred tax buckets that I can also invest. You don't have to just be in the stock market. I could invest those in real estate or other private assets. But that's what this trifecta is nice about. And this is just, as I think of my own scenario here, I'm over here building income over here on this side to go acquire assets. Because as I'm acquiring assets on this right side, let's say just the rental property, okay, very common. I own rental properties. And why do I do that? Well, because those rental properties don't require Matt to work. Over here on the business and operation, Matt's got to work. Okay. Over here, so like Matt's working over here, by the way, on the LLC S Corp, Matt's ass is over here working. Okay. Over here on the LLC assets and investment side, my assets are working for me. Now I got to make decisions to make sure stuff's happening properly, but it's way less work over here. And so we want to build assets that can produce income for us. That's true wealth. Is once I get over here and my assets are producing income for me. Now, some people are like, but Matt, eventually I can become chairman of the board of my business over here. I don't have to be involved day to day. I can take a back seat. That's true. You might not be trying to grow or scale it anymore. You kind of put it maybe on cruise control, or maybe the business makes exceptional income and you're able to hire a team and they can run the business. But for most small business owners in particular, sure, we want to reinvest money and grow the business, but also put money over here to continue to build assets where those assets can work for you. They can appreciate over time. And then, but why not get assets that can produce cash flow for you at the same time so you can buy more assets? All right. And then we just, that thing just keeps perpetuating itself and growing. And that's how you truly will grow your net worth and have true wealth. All right. Do we have any questions on topic on entity tax and planning?
We do have one.
Right,
this is from Instagram. Miss Marcella Martinez said, as a real estate investor who will be doing wholesaling all across the country, do I open LLCs in those states or can I just operate where I reside, California? Also, what if I open an LLC in a Wyoming holding company?
Okay. Good question. Marcella, I was loving everything you were saying until you said California. All right. So our rule of thumb is we're going to set up in the LLC in the state where you're conducting business. So if you live in California and you want to have an LLC, unfortunately, you're going to need to do a California LLC. Now, I know a lot of people are sitting there and they're like, but Matt, California has an $800 a year franchise tax for LLCs. Yeah. And even if you set one up in Wyoming and you're doing business in California, which, by the way, making phone calls and doing wholesaling because you live in California, even though it's a Wyoming LLC for a property in Minnesota, you still owe the $800 franchise tax as far as the state of California is concerned. So the Wyoming entity or an entity in another state is not going to get you out of the franchise tax. So we're just going to say, if you want to do the entity, you want the asset protection, you're trying to really build that business and grow it, you're going to need to just do a California LLC. There's not a legit way to skip that unless you move out of California. Okay. So now $800 a year, you got to decide if that's worth it or not. I don't know how many wholesaling deals you have. There is some liability and risks. A deal could go bad, right? So it's nice to have an LLC for asset protection. Now, would I use a Wyoming holding company in general? Let me go back to the trifecta. I'm going to do a new one here, though. So some people will use a structure where they use multiple holding companies. And then this is maybe the S Corp LLC taxes and S Corp. And then this is another LLC that owns the property. Some people will do this structure. Now, by the way, they're using these are that's Wyoming, WA. They're on those. But let's say this is you here, Marcella. You've got an LLC in California that you do wholesaling. That's your business. Okay. That's selling goods or services. Like really, you're assigning contracts. You're basically buying and selling contracts. It's not a rental property. It's not an investment asset over here. So wholesaling income is going to be ordinary income. So I'm going to put over here on the business side as opposed to assets or investments. So you could use these Wyoming LLCs as holding companies here. I'm not against that. It's just, it doesn't provide a lot of benefit unless you have a lot of assets. So I kind of say if you have $1 million net worth or more, we might look at adding in a holding company here or here. And generally, we're going to just do it here. You could do one over here, and I see people do it. I see the strategy out there. I'm not against it. It's just, I'd probably skip it if I were you. I mean, I don't know. If you're like, well, Matt, I got a $5 million real estate portfolio. I'm like, all right, let's do it. Let's add it in. But the holding company is just kind of this another layer of asset protection. What it's really preventing is a liability you get here personally. You get a judgment against you personally, Marcella. It prevents someone from going up here to the LLC to force you to sell the rental property. It forces them to go to the Wyoming LLC here where they get stuck actually. Because Wyoming LLCs have this special protection where any liability against the owner, they can't get into the LLC and force the sale of assets. So it's giving you this unique type of asset protection. Generally with an LLC, what we're doing is we're preventing something that happens at the LLC from someone coming down to you personally. LLCs in all 50 states give you that protection. Wyoming ones just protect it both ways. This is called inside and outside liability. So, and we'll probably do another asset protection. I think I've got some videos, by the way, on the Wyoming LLC in particular. We'll share those in here. I've got a good video on when to use a Wyoming LLC. But for your question, Marcella, I would probably just do a California LLC. I know you're like, that doesn't sound very smart and strategic because California is $800, but there's no way around the $800 legally. I don't think the Wyoming LLC is going to give you more benefit right now. But if you're like, Matt, I got a lot of assets, let's talk about it. We might do that, but you'll really need a consult to figure out what works in your scenario best. Now, again, clients with $1 million or more of assets, I'm going to add that in. If you're like, Matt, I'm just trying to make money on the side. This is a side hustle. I'm trying to build wealth. I'm just getting started. Or I've got a lot of debt I still got to get out of. I just do the California LLC. I know it's $800. Now, for everyone else, the other thing, we're just going to still do the LLC in the state you reside. Also, if this was a rental property, Marcella, I would do the same. Let's say there's a rental property in Minnesota. We're going to do a Minnesota LLC actually, because it's a property in Minnesota. Just because you're wholesaling contracts in multiple states, you don't actually have to register your entity in every state. Okay. You could if you take titles of property, but if you're just wholesaling the contracts, you don't have to register the entity in every state. So you could use that California LLC in all 50 states to do wholesaling. All right. Do we have another question there, Tristan? Okay. All right. Well, let me go to the questions that came in by YouTube. By the way, you can ask questions on YouTube here in the channel. If they're applicable to everybody, we'll pull them out for the Team Wealth. You can also go to mattsorensen.com and hit the Ask Matt button, and you can ask any questions there. So I pull a lot of those for the lives, and let me hit those here today. All right. This was from XAXB4178. He said, I was wondering if you could really explain this to me in a way that I can understand. This March, I opened a Roth IRA and made the max contribution for last year, $6,500, and this year, $7,000. Okay, good. You could do both years' contributions in one before April 15th because you got last year's and this year. It says, I also opened a SEP IRA because I am in a partnership. My accountant suggests I should use a traditional IRA instead. Can I make non-deductible contributions to this SEP throughout the year? Do I fill out a form whenever I transfer the money into the account? My goal is to pay the taxes now because I can't tolerate future uncertainty. Okay. XAXB4178. You're doing it wrong. I like the Roth, doing the Roth contribution for last year and this year. Okay, you got $13,500 of Roth. I presume you're under the income limits for Roth, or you did a backdoor Roth IRA. I don't know how you did the Roth. So we've got backdoor Roth IRA videos. If you make more like 150K a year, single, 200K married, we can throw those numbers into the chat. But if you're making over those amounts, you have to do what's called a backdoor Roth. The only reason I bring that up is because you're also talking about doing a SEP and you're talking about putting more money in retirement account. That usually means you're high income because you've got more money to work with here. So I don't know. Just want to make sure you're getting that right. All right. Can you make non-deductible contributions to a SEP? I don't think so. I mean, I think what you're trying to do is a backdoor Roth IRA using a SEP. No. I've never seen that. What I would do if I were you is I would look at doing a solo 401k. Actually, if you're trying to max out contributions and you want them to be Roth, I would look at doing a Roth solo 401k. Now, SEP IRAs, this has been the first year, this last year, where you can do Roth contributions to a SEP IRA. You just never able to do that. New law passed a few years back and said starting in 2023, you can make Roth contributions to a SEP IRA. However, the IRS has not given out the forms, the model guidance, the custodial agreements, which all needs to be done for any IRA provider to actually do that. We still don't have it and are waiting for it from the IRS. So right now, you kind of like have zero uncertainty about a Roth SEP IRA. So is it possible you could do a backdoor Roth SEP IRA? Possible. Nobody's done it yet. XAX B4178, you'd be the first. Really, I don't know anyone doing Roth SEP IRAs yet either. Those are still waiting for guidance and model forms from the IRS. So what I would do for now is do a solo 401k. We like it better than the SEP IRAs anyway. And you can put the same amount of max money, $69K a year in the solo 401k, plus you can do the Roth IRA contribution on top of it. That could be 100% Roth dollars for the $69,000. So if you're self-employed with no employees, you can have a partner in your business, and you can still do the solo 401k. So I'd get over to our schedule a call with one of our account reps at Directed IRA, where we help clients go over the solo 401k. We set them up in a combination with our law firm and Directed, but our new accounts team could definitely help you on that, especially if you're planning to self-direct. All right, another question from YouTube, which was 22 video 11. It says, hi, Matt, I'm 65 and I have an IRA, traditional, managed, invested into a mutual fund, but I no longer have a paying job. Should I switch to a self-directed IRA or convert it to a Roth IRA? Okay, good question. And I can never tell you what you should do. That's not my job. That's not my role. I'm just telling you what you could do. It all depends on your situation. You threw in some interesting stuff there, though. I'm 65 and no longer have a paying job. I need to know what other assets you have. Do you have a couple million of assets to live comfortably in retirement? Or do you, the only thing you have is a $100,000 traditional IRA? If that's the only thing you have, I might not be doing self-directing. I might not care about converting to Roth at this point. You're not in wealth building mode anymore. You're kind of in wealth preservation at 65. And if you don't have other assets, I don't know that self-directing is right for you. Self-directing is not for everyone. If you're self-directing your IRA, which we love, don't get me wrong, I wrote the book about how to self-direct your IRA. I do it for mine. It's what I want all my clients to do, but it's not for everyone. My parents don't self-direct their retirement account, okay? Only some of my siblings do, okay? It's just like, I don't know. It's not for everyone. What you should do is what's right for your situation. The best people at self-directing are business owners, entrepreneurs, real estate investors. They already know how to analyze other assets, take risks. They're more entrepreneurial, and they're great self-directed investors because that's kind of what they do all day long. They're in that space of real estate investing or small business, but now they're just using their retirement account to invest in those things that they know. So it's possible it could work for you. I just don't know your specific situation, and it depends on your assets. But at your age and not having a job, those are the only facts you threw in there. I'm probably saying no. And some of you might be surprised. Matt's telling someone not to self-direct their IRA. Matt's telling someone not to convert their Roth IRA. That's right. It all depends on your situation. All right. Max Flyer asked, if I'm getting a settlement, can I have it invested into a Roth IRA? Okay, now remember, when you put money in a Roth IRA, there's only so much you can put in as a contribution. So right now you can put $7,000 a year into the Roth IRA, so long as you have earned income though. Contributions to a Roth IRA, you must have 7,000 of earned income to put $7,000 into a Roth IRA. So Max Flyer 98, it depends if you at least made $7,000 during the year. The settlement is just, doesn't matter. Like, that's not earned income. Let's say you got a $100,000 settlement and you made 50 grand during the year through a job, but you spent the 50 grand. So you're like, but I have this 100K from a settlement. Can I put it into the Roth IRA? Yeah, you can put 7,000 in because you made 50K through the year. So you have 50,000 of earned income. The actual money you put into it doesn't matter. It's just, did you have earned income through the year? Okay. All right. Mr. Perfect. Mr. Perfect asks, do you depreciate what you paid or what the property's worth minus the land value? Example, paid $400,000 10 years ago, lived it for 10 years, then turned it into a rental, but now home is worth $800K. Do you depreciate based on $400K or $800K? All right, great question. Depreciation is based on cost. What is your cost basis when you acquired the property? So if I bought a property, let's say I bought a property for $500K and let's actually run with the example. Well, let me do $500K here. Okay. Where'd my pen go? All right. Okay, let's say I bought a property for $500K. And let's say 100K of that is the land value, 400K is the property, the actual building, okay? So when you have rental real estate, okay, you get to depreciate the value of the property, the building over time. You don't get to depreciate the land, but it's your cost basis. It's not what the property's worth. Even if this was a residence that you turned into a rental property, you don't get to like step up the cost basis because you've turned it into a rental. And you can't sell it to yourself either. So I don't see any way there to up the cost basis. So Max and Flyer, or no, sorry, this is Mr. Perfect. If you paid 400K for it 10 years ago, and let's say 75K of that is the land value, you're going to have 25K that you can you're going to have 75K was land value. You're going to have 325K that you can depreciate over time now that you turn it into a rental. All right, let's take the last question here, and then we got to wrap up. If there's anybody live that need to ask a question here, okay, let's get your hands up. It looks like we're good there. All right, this was a good question from Justin Francis. Says, great video. Information is really helpful. Can you explain more about the self-rental for someone who isn't a real estate professional? Is the benefit to someone similar to someone who is a real estate professional? For example, a doctor who's also a real estate investor and buys real estate and rents it back to their practice. Both doctor and investor have the same ownership for both the real estate and the medical doctor operations. Both of them are not real estate professionals and neither have a significant other that is a real estate professional. Yes, Justin Francis, this is exactly what I'm talking about. You can use the self-rental rule here where you can group in the property with your practice and you can take the losses from the rental real estate that you are renting to your own practice to offset income in the practice, in the business itself. This is the self-rental rule. It's very unique. We've been teaching our clients it more and more the last couple of years, and that exact example you gave is exactly what you can do. You do not have to be a real estate professional. A lot of people know if I have rental real estate losses, I want to offset my ordinary income. The only way I get those rental real estate losses to offset my ordinary income is if I'm a real estate professional or if my spouse is a real estate professional. And there's certain requirements to become a real estate professional. Not everyone can meet it. I can't be a real estate professional, okay? I'd love to be, but I can't. However, there's a different rule for business owners who own their own property that is used in the business, leasing it to themselves. They can use those losses on that property against that actual business that is being operated in it. So in the example here, as Justin mentioned, yes, you could use those rental real estate losses from the building being leased to your practice. So now, by the way, get over to the law firm KQS Lawyers. Our lawyers can help you on that, analyze that, help you set up any of the LLCs or tax structure to make sure it's done right between your practice and also the rental property entity that's going to own the property. Also, your account needs to be looped in because this needs to be grouped right, or there's a special election you need to make in order to do this. And if you don't have a great accountant, by the way, get to the Main Street Tax Pro Network. Highly recommend. That's my law firm partner, Mark J. Kohler. He's got a whole tax and accounting network. He teaches CPAs and accountants across the country on Main Street tax planning, like real strategies that real people use that our lawyers have been teaching and we've been doing for a couple of decades now. But there's actually accountants out there that are living and breathing this stuff that can help you on it. So if you get to markjkohler.com, you can find a great accountant that can help you actually execute this strategy as well from a advisory or from just also a tax return standpoint. All right. Looking over, no pending questions. All right, great. Well, welcome everybody who's on here. You didn't catch any of the front end of this. This is recorded. It gets posted back up. And I'm going to be back here, of course, every Monday. Come on at noon Arizona time. Let me just say that. Arizona goes between Mountain and Pacific, but we're here at noon every Monday. Make sure you're subscribed to the channel. You'll get notified when we go live. You can also join the private Facebook group, Team Wealth. We're eventually going to be coming onto that more and more often, providing more content, information, and strategies. So much we're going to be doing over there. But for now, please get signed up. Make sure you're subscribed to the YouTube channel. And if you have a question for next week's live, please get over to mattsorensen.com, hit the Ask Matt button, and you can ask your questions there.